Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Pederson.
Thank you for joining the Real Estate Risk Report. I'm your host, as always, Lance Pederson. So today we're going to have a lively conversation. We're going to get in the weeds a little bit, but I'm super excited about this. So we have Stefan Tsvetkov with Pepela Equity with us. How you doing, Stefan?
Doing well, thanks. Thanks for having me.
Yeah, no, excited to have you on. So today we're going to get into some of the stuff. I think Stefan's got an interesting sort of look at how, to kind of look at things, multifamily in particular, sort of where he specializes, and but he's got a much more analytical approach to sort of, looking back in time at the different, 2008 and 2009, all these different things, and sort of more of a numbers based approach to how people should look at things. So should be really good. But before we kind of jump into all that stuff, why don't you share with us sort of how'd you get into this industry? How'd you get in sort of real estate? I know you kind of came in from sort of a different angle than I think most have in this business, but maybe give us a bit of your origin story and, what led you to kind of, get into the multifamily game.
Yeah, of course. Yes. So I was previously a financial engineer by training. So I worked basically doing portfolio management for an insurance company for about 10 years. So I was managing with my colleagues, a big derivatives portfolio. So from that, how I got into real estate. So I purchased my first multifamily so I'm from the New York City area. I purchased my first multifamily in New Jersey. It was a fourplex. It happened to be a nice fourplex actually, where I liked this particular unit that I lived in. So I kind of moved into, that's how I got into getting exposure to real estate. I liked even the cap rate or the return that I was seeing on that, sort of owner occupied investment. And I was living rent free, and that was the usual path to getting into it. And I thought that's great. You use leverage, you have a lot of you get a lot of benefit to that of either cash flow or sort of implicit cash flow in that instance when you are owner occupying. So that's how I got in. From there, I've been doing more multifamily investments, various strategies, primarily stabilized assets. I don't do excessive renovation. I sort of seek for arbitrage. So my approach is more I try to find a variety of where I feel in the industry, if you take it's more out of theory. If you take the regular residential investment in the US, from TV shows, etc., there's so much, this kind of flipping perspective where people kind of can understand that notion of, where they expect if they put in the work and they kind of improve an asset, okay, there will be some kind of upside, which is not necessarily the case. Okay, maybe that's compensation for your work. Is it actually arbitrage? Is it compensation for your work? That can depend, but my perspective was, okay, there could be a variety of reasons to price inefficiency or even income inefficiency in real estate. It's a relatively liquid market. I was also thinking if I should get into cryptocurrency arbitrage at some point, and that was another thing that I was doing programmatically. So I would write my code and kind of trade, pairs between exchanges, things like that, and try to see if that can, that can maybe scale. And it works as well. It's very complex technologically, and I just felt real estate is okay. Well, you have so much arbitrage. It's such big notionals, in essence, and it is it's just easier and more attractive. And so I just basically viewed it as, okay, so finance person, that's an asset that has all this potential. If you try to find a deal in terms of finding a deal, if you try to find a deal in finance, it's really difficult, especially in public markets, right? How are you going to find something that's undervalued, for example, right?
Right. Yep.
that's just, that's really hard. And so I just felt that's how to say, I just felt that to a finance person, it's sort of like a finance person's, I don't know, dream playground, if you will. It's on one side, like people would say, okay, it's this field that doesn't have it's not so technical. You're dealing with physical assets. And like my thinking was more, okay, try to get over the physical asset aspect and, have that organized in a way and just utilize all the sort of financial asset benefit of the space. And so that's sort of a summary of where I was coming from with
it makes a lot of sense. Because I think you're right? Like the public markets, they're extremely efficient. So it's difficult to, as you're saying, to identify and locate value or the ability to generate alpha, because it's everything's priced more or less right. Whereas in real estate, it's very fragmented and it's very inefficient. There are opportunities in the market where things are mispriced. And I think to your point is that, of course, the sexy hot thing in the last handful of years, of course, has been, value add multifamily in particular, which to your point is, you go in and you take something that's sort of run down and you add value, and but it's a lot of work. And it's not without its risk, of course, because once you start, having to do anything to a unit and all the sorts of things, you get subs involved and all that sort of stuff, it actually adds and introduces more risk. So what one could argue that, are you even really being compensated? I mean, obviously the sponsor who's doing it, hopes that they come out the other end by, forcing appreciation and creating value and that sort of thing. But I think if I hear what you're saying, well, you can go out and look at the market. And if we just narrow it, in your case, you kind of narrowed it down to multifamily in particular. There are certain markets, sub-markets, even sizes. I think you were saying before we hit record is where there is even more inefficiency. So maybe you can kind of touch on like what your process is, right, for sort of narrowing down your what you're looking at. Like how would you? One thing to have like a theory, but how do you actually put that sort of into practice?
Yeah, and I loved your summary, and it's exactly like the opportunity to generate alpha, as you call it. It's kind of a finance terms, for the people in the audience who don't come from finance. It's exactly I think a big advantage in this industry. And so on the inefficiency part, I think, well, it's a little complex to say, okay, if we assume real estate is, broadly speaking, is inefficient. I'd say fragmented is a perfect word. Yes. So that brings like in some portions of it inefficiency, but I think it's, let's say technically or like academically, like there are like papers, that try to show inefficiency, and that's slightly a different question than maybe what we as investors think. Like, for example, it would be one of the studies is like there's an Istanbul prices study that I think is one of the more known studies of efficiency in real estate. And I think it basically kind of disproved what they call weak form efficiency, where weak form efficiency is historical prices predicting future prices, essentially. Mm-hmm. So that was kind of disproved. And I mean, I just wanted to kind of start with that, like before going on to own deals. And then there was also, I did my own, at my data LOC, I did my own autocorrelation studies of different markets. And it's pretty simple. It's just like a 1 year log, of prices versus, let's say whether price performance a year back predicts price performance, next year, let's say, or current year. And that was, that showed some of the markets in US, and let's say if we look at not markets, but states, that showed like states like Florida and even Massachusetts and, different places like heavily autocorrelated, like about like Florida, I think it was like about 77%. So basically there's a lot of trend, a lot of momentum, and sort of lack of even weak form efficiency. That's just on the market side. On the deal side, I think like the inefficiency at the small deal size is enormous. So I've been constantly hesitant. So as far as my process for selecting deals, I've been constantly thinking of okay, what's the absolute return of the investment, and then the relative, right? And now if we have a really big deal that is like a $5 million deal or something, now is that something I want to invest in? And like so far, it's been maybe not the case. I also haven't gotten sufficiently into the. It's hard to get data on bigger on commercial and CRE, right? Because there's very little data. It's very few data points, and I feel like CRE investors, they just they either focus on like that one tiny market or 5 tiny markets, and they know them really well, and so they can. They get a little bit of data from the history, kind of like having this kind of intuition and like accumulatedness from being there for years. But even that is not so well. It could be sufficient, but it's not like it's still very few data points. If you look at if you take, and of course most of the stuff doesn't even get posted online. And I had it I host a webinar, and I had a guy who is like a startup founder who hosts one of the main CRE listing platforms like WhoopNet, and he was saying it's pretty much nothing gets posted there. I mean, and nothing gets a lot of stuff gets posted there, but at certain deal sizes, things, as we know, get kind of passed between agents and to their preferred clients and stuff like that. So there is this question of, if you are having this more analytical approach and you don't so much like agents, maybe you're not so agent oriented. Now in the bigger series space, you would, if you're having, let's say, approach that I'm having in the bigger series space, you would probably find a bit less opportunities at this stage than in the small one. Well, in the small multifamily space, there will be lots of inefficiency. One thing on that I wanted to say, I hear a lot of, for example, multifamily syndicators. I hear a lot in their thought process for how they moved from, they were investing in duplexes or single family and stuff like that. They say it was too much hassle. You buy the single family, you make $100 a month, like this kind of thing. And then so that if it was kind of obvious, that AUM or assets under management or bigger asset sizes would lead to, more, absolute returns even. And that's not obvious actually, because I've been looking at my firm, I've been working at structuring it as a fund potentially, besides my own deals. And I've been seeing where you can have a tiny asset, and just to give, say, I started with my investment of about $800K and kind of small multifamily, not CRE, 600, $800K were my first deals.
Yeah.
And as I discovered more data and more information about the market, I would say I started buying even smaller deals, and it's been getting to 100,000 deals and things like that, which might sound ridiculous to some, but it's actually so a deal that is, here's just a perspective to investors for that. So when people speak of cash flow, cash flow is a different variable, right? So it's a cap rates versus interest rates spread, basically.
Yep.
Right? Okay, there's principal bundled in. You can call it surplus instead of cash flow. But roughly it's cap rates versus interest rate spread, and then you lever that. So if you have a deal that has a 20 cap, now people believe they don't exist or they only exist in rough areas, and it's mostly true, but they do exist in safe areas as well, and I can explain why. So if you have a 20 cap deal that is the minute amount of 125,000 value, that cash flows is $1 million deal. So a portfolio of assets that has a tiny value, and that I'm not suggesting one should do, even I try to avoid this kind of minute sizes, but it's purely a conceptual discussion that a portfolio of 625K that happens to be really picking the at the end of the distribution in residential real estate is going to have the cash flow of a $5 million asset, and a portfolio of $2.5 million of those is going to have the cash flow of 8 times that is $20 million portfolio of CRE. And that's purely in cash flow terms. So one of the, I think, kind of the myths of multifamily CRE is, we invest in real estate, we invest for cash flow, and we we're picking those big assets because invest for cash flow. I mean, it's not exactly the case. Yes, there is cash flow, and I mean, some of them could have even a decent cap in a way, and the cash flow is there kind of to buffer you. I mean, obviously, it covers the expenses enough, etc., so that you execute your value add. But to me, CRE is more of a value add play, and appreciation play.
I agree.
And this kind of like, and there can be crazy multiples of where like a small, like I said, a multiple of 8. So the cash flow of a tiny cheap deal is a multiple of 8. So the recent property that I bought that is for about $120K has the cash flow of approximately my 800,000 other deal, and that's that's just how this works. Why? Because it's a spread variable. Additionally, you leverage. So now another thing I want to draw people's attention is like a return metric. So if we take cash on cash and let's say in cap rate, cash on cash and IRR, right? Mm-hmm. Those 3 metrics.
Yep.
So let's say we have a and maybe it's kind of next stating to obvious thing, but we have so if you have a cap rate, if interest rates are let's say 5%,
sure.
and you have a cap rate of 10. Okay, so what is the meaning of that to an invest? And then you have a little bit of value add or a little bit of pricing efficiency as well. So how does that translate like to, let's at least my thought process for evaluating deals is okay. So it's a cap rate of 10 is if you're levered 5 times and you have interest rates 5, it's sort of okay, about 25% cash on cash return. And then if you have a little bit of pricing efficiency, that strengthens your IRR a little further. So 25, maybe it will become 30% IRR in that instance or something like that. But again, roughly speaking, like a metric like cash on cash is, a metric like cap rate is okay, purely the property profitability, just for kind of maybe educational purpose, like to some of the audience. And then a metric like cash on cash is okay, property profitability, but also with the leverage and financing factored. And then IRR is okay, cash on cash, but now with also the pricing efficiency and value add factored in. And then there's of course all kinds of criticisms of IRR, etc. But I mean that's the general, the general concept there. But yeah, that's one thing I wanted to say. Now, on the contrary, between small and big multifamily, I would say value add seems to scale. So that's interesting. Mm-hmm. It seems like you can have deals for $10 million that also get 50%, or 20% or something upside. So that's actually quite interesting. That really makes the industry, I think, very lucrative in that sense. But in cash flow to a lesser extent. I mean, again, it's because if you have a 6 cap, for example, obviously, and you have $5 million there, I don't want to invest there myself because I can invest like a tiny amount of money in like tiny deals and achieve the same cash flow. So that's just my own as a person, private investor, at least perspective. Now, another thing to say to passive investors, like on the risk side, or how to say, now, if you have syndicators and you invest in syndicated deals, for the benefits of the real estate benefits of cash flow. Now, do you get cash flow necessarily? No. I mean, you get your preferred return now. So you get 8% cash flow right now. 8% is good. Okay, you can say maybe because I don't know, maybe the perspective is that 8% is good, and that's why. Yeah. But I'm just saying it's not exactly the same as if you did invest in your own deal. I mean, just a comment where at a 5% cap rate interest rate spread, you would have a 20% cash flow, not 8% cash flow. So that's just something, to say. Now, of course, at the end that, CRE or other, whichever, could be not CRE, could be residential, like could be a private equity fund or something, even for different size deals. But let's say it's going to pay at the end, at a certain point. More substantially, or they could refinance, they could return your distribution, etc. But I mean, that's just something to say. I'd say a little bit of the risk side now. I don't know if it's that that much cash flow in that sense. From that, so I mean, this is just some perspective I have as an investor and in my own selection. So it's arbitrage. So I look for like things like even like condo conversions. I look for changing appraisal methods. Like changing if you a fourplex to a fiveplex could potentially double the appraisal.
Right.
Right. So it's like all these kind of creative, creative kind of strategies, and I'd say I aim to take out my investment in 100% of the cases, and I don't actually I never do like extensive renovation. So it could be zero renovation and still take out all your investment. So that's another thing, like infinite return when you talk in real estate, or sort of the BRRR.
That's right.
BRRR kind of strategy with whichever asset size, let's say, it's that's something I feel it's achievable. It's not necessarily you have to get and gut renovate a property, so that can be achievable in all kinds of scenarios. In illiquid markets, you can be buying things below market, 25% below market. And if that's the case, like let's say 33% from the bottom number, let's say, and if that's the case, it's 75% LTV. You kind of refinance out of the deal, and that's it. And that's something I do actually. I just buy an asset, I just refinance out of the deal. I didn't even renovate it. And I mean, again, one can consider now: are you helping enough people by sort of just buying stabilized things and not improving the housing? So there's this kind of ethical kind of question. But I mean, just saying that in a market like real estate that is like I said, arguably inefficient in some of its segments, let's say, it's you don't have to. It's not a full renovation that leads to that inefficiency. And in fact, if it's a full renovation, does it mean there's going to be an upside above that? Let's say that your purchase plus renovation, then that has a discrepancy? Not necessarily, right? So it's not exactly. So it's not that leads to the inefficiency only. It's just could be pure liquidity, could be regulatory, like I said, like condominium conversions example, changing appraisal methods example. I need to think of, like, I had a short list of different strategies, and I pretty much have done like a few of them at this point. So I feel like almost every different property is like a different sort of arbitrage strategy, for me at least.
Yeah, I mean that's I think that's what's interesting about it, right? Is to say that it's not just it's the whole thesis of, I'd rather do a 100-unit deal than a 20-unit deal because it's the same amount of work to do, and like you said, just some of these things, they're not technically accurate, right? Like per se. And it doesn't mean, so for you, once again, you sit down and say, well, here's how I look at deals. And you say, well, I don't want to do extensive renovations. I want to find inefficiencies, whether it's, like you said, going from a 4-unit to a 5-unit because the valuation methodology is different, whatever it is, right? Like those are the little things. If you're out there just looking at the whole landscape, there's tons of opportunities. And if you filter it down to look at now where you're just honing in on those sorts of situations, to your point, it's a lot of work, but it's also a lot of work for the syndicator who's sitting there looking for all the 100 units deals and competing against a bunch of people. So one could argue the amount of effort put forth to actually be in the acquisition game, no matter what, it doesn't matter what you do, it's a lot of effort, right? So, and for you, it's using sort of a different strategy or criteria through which you sort of filter the universe. The whole like ethical or moral stance aside of whether or not one should be like, buying property and improving it and, whatever, like, we'll take that off the table because it's like a whole different conversation, right? But it's, yeah. I mean, So, I think that's interesting. So for you then, when you're looking at all this stuff, and you mentioned it before we hit record here, just about there's certain markets right now that are like darlings in the country. You mentioned Boise, Idaho as an example. Yeah. So and I think that there is some fluidity to that. Obviously, we're in this great reshuffling is taking place right now due to the pandemic, and there's some other interesting dynamics, but it's always been fluid. Markets, markets, they come and go, obviously, because of these dynamics. Things happen and people catch on to it. And then all of a sudden, what was a good buy is no longer a good buy. So So for you, how do you keep on top of that? And maybe you can speak to a few of these markets that you've sort of done an assessment on that you're like, hey, I'm bullish on this market, if you're willing to share that with us.
Yeah.
Whereas I'm not, I'm bearish on this other.
Yeah, sure. Yeah, that's an interesting topic indeed. And thanks for raising it. So, I mean, first, my thought process on that, so I produce metrics. So at Envy Analytics, my data OC, I produce metrics for overvalued markets. Now, it's something that everybody can do on his own in a simple. So I sort of do like a more complex regression of multiple factors. But what I've been trying to draw people's attention is in a very simple sense by just using price income ratio. One could have, it's going to may sound silly, predicted, quote unquote, that post 2007 drops, and they were almost like fitting like a glove to the price to income deviations from historical price to income ratios in different states. And they were like 85% predictable. And that's a study that I did. So I've been using this for my own investment because at the beginning of COVID, I was worried, like, should I invest like in certain markets? What if the prices, turn, what if we hit the peak in the cycle? This kind of timing uncertainty, like this constant thing, like the same way if you invest in stocks, like you keep worrying, what's going to happen in the future. But then you have investors, value investors, like Warren Buffett or whoever, who they don't even think of that because they have a very rigorous approach. Mm-hmm. And I wanted to bring this same mindset and in the notion of using valuation metrics in real estate, which has been mentioned by some economists, has been used. So there was a study by, I think, Niraj Shah is the name, like an economist who did it about around 2019. He showed like some of the countries that are overvalued. Then there is in 2005 and 2006, there was, what's the name? Ingo Windsor. Ingo Windsor is a guy in Massachusetts. So he has a company that kind of publishes. I think he showed up on Neil Bauer and some of those shows where so he has a company that publishes metrics for markets that basically do that basically show like which markets are overvalued. In 2005, 2006, he was on CNN, and he was like saying that certain markets, specific markets in California and Florida, etc., are dangerously overvalued. And that was actually, because I hear like people on LinkedIn or somewhere saying, nobody could predict. That's not true. It's predicted. You not only you should have it in your investment approach. So I kind of urge investment managers to have a full history of valuations for their market. So it means at every time point, is your market at, what's the ratio? Is your market at 111%, 11% overvalued, or is it, 5% undervalued, or is it, just fairly valued? And that to have the full history, because if you don't have a full history of that, you don't even know price performance. Because what is the window? Like, what is the time horizon? Right? I mean, it's just like so simple things in a way. And then like and another thing in finance. So there is, some of the, I don't know if like John Hussman. So John Hussman is from Hussman Investment Trust. So that's a hedge fund. And so he is like, I don't know if he's a PhD in finance, maybe, or economics. I'm not sure which of the two. But he had a table, like a very interesting table, where he was showing different valuation metrics, for the most known on big price earnings ratios, and then some metrics that his company devised or created, and their correlation to subsequent actual standard, S&P 500 total returns. And so he showed, different metrics perform differently well, and they had devised a metric that had like I believe 91% correlation to the subsequent returns, and that's doable. Now, that doesn't mean you're going to be able to predict the price performance. That's not the case, and that's not the target predictor here, even a target predicted variable. But what seems relatively well and easily predictable is the magnitude of drops. So you don't know when it's going to happen, but the magnitude. So we use like an example, and so that's kind of like, maybe I'm going too much, but if I use an example in it's just like my thought process, and like I will go on like which markets I see right now, and like what are my views on like different markets and that. But so in 2007 at the peak, if we look at states, there were let's say 4 states that were super overvalued. There was California, Florida, Nevada, and Arizona. So they were in the 40 to 60% range of overvaluedness, let's say, by taking, and when I say overvaluedness, it's price income ratios, but really taking you need to take a well-selected historical window that's kind of a moving window. And then at each region is going to be a different peak at a different date, and you have this historical kind of moving average, thing, and deviation relative to that historical price income ratio. That's what's going to predict the drop. And so that technically means it's not price incomes that are the predictor, it's everything else. It's basically saying, okay, we should not look at just prices, we should normalize prices by income. We are looking for a kind of remainder term, like where markets, prices have moved irrationally kind of above a certain level. And that's what we are trying to predict. And if we take this kind of moving historical average, we would be able to see, we would inherently also factor kind of that average will be moving up. So like, and also that also price income is called affordability, right? So that's also affordability. And then you can look at like in certain cities, let's say if maybe San Francisco had a price income of, let's say, just 5 somewhere historically, like many years ago, and maybe now San Francisco has affordability of 20. But that does not mean it's overvalued.
Right.
It will be the 20 affordability if it moves kind of too quickly or above like its historical level, and so that's the kind of thing. So it's this approach, and then one can factor in additional, like I did it. So at my LLC, I try to do it like in a more technical way. I try to factor in housing shortage, so where population and housing supply in different regions, and I try to reflect that, because the thing is that affordability does shift up with housing shortage, and it's kind of a legitimate reason for it to shift up. So this kind of approach. And in 2007, so there were those 4 states, California, Florida, Arizona, Nevada, were like 40 to 60% on this valuation metric, and the actual drops that happened were like 40 to 50% roughly. 40 to 55 or something like that. So it was like really much in line. And what happened on the opposite end of the spectrum in undervalued markets was one of the most kind of stunning findings for me in this study, because at the opposite end of the spectrum, we had a few undervalued states at the time, about 10 of them, for example, by the way, including Texas even at the time. Texas, strong performer, was actually undervalued then at like just about 5% undervalued. So the drop post the peak in Texas was only 4%. The drop at the state level, now specific cities, etc., they could have dropped more, but it's quite interesting. And then across all 10 states that were overvalued, the median drop was 4%, and that's like crazy, because there was North Dakota that prices stayed the same at the time. So that was just that just stood to show that, okay, you have a time with a lot of, call it like financial engineering, like mortgage backed securities and stuff like that, excessive credit, and one could think that that's that the drops 40-50% in some markets and close to 0% in other markets, that they would be predictable by something really complex, but they were actually predictable by just price earnings, price income deviations. And so that's what I've been talking to investment managers, in my opinion, as a risk measure, a market risk measure in their portfolio, to be using, to be doing that, because to be using and have a full history evaluations. When you do this, you also know where your market performed, how your market performed. A good example is Florida, the state of Florida. So the state of Florida prices are roughly at similar levels to the peak of 2007 right now. So this is a market that then really boomed and really crashed down and came back into there. So it's like really volatile. So is it a strong market? No, we know it's a strong market because I don't even have statistics, but maybe 80% of the big multifamily operators, do Florida and Texas. So we know that's a strong market, and and they have done well, etc. But we don't just know it by looking at purely prices. If you know the valuation history, and you take Florida's price performance from the time when it was fairly valued, now you know that that's actually the basically the only super performer in the whole eastern half of the U.S. It's not obvious if you don't do that, and so that's another thing. So having a history of valuations, like all time points, basically quarterly or whatever, is gonna help you track. Is gonna give you a better perspective of your performance, and it's gonna also now, for example, like when markets are fairly valued actually right now, and I can mention a few examples. But if we're having, let's say, supposing the prospect of inflation, and let's say assets appreciate faster, maybe too fast at some point, it's going to be interesting for me to see in the next couple of years what's going to happen, because before 2007, in 2002, 2003, markets were also fairly valued, and they very quickly became overvalued over 2-3 years.
Yeah.
So now it's very fairly valued. There is, it's a great market. All metrics are really nice, except Idaho, perhaps. but for the most part, and but it's going to be interesting to see what happens, and that's why I think it's good to be able to track that and see. And I'm happy I have it for my own, for my own investment, that I can basically, not worry, but just more rigorous. It's a simple thing. It's a simple thing on the market side. Yeah, that's like on the risk, kind of picking, like gauging risk. It's a simple risk management kind of measure. It doesn't tell you price performance. Price performance itself, that's better predictable by autocorrelation, like we mentioned earlier. Mm-hmm. If you're investing in Florida and you want to predict our price is going to go up, you just look at the prices went up before, and that's actually good enough, 77% predictive of future prices.
Yeah.
So that's in Florida. It's different in other places. Now, if you're in Alaska, it happens to be the only place that's negatively autocorrelated. So Alaska, like last year performance actually predicts the opposite this year, which is kind of strange. But but that's an exception.
An outlier. Yeah, it's an outlier. Yeah.
Anyways, yeah. So those are like some.
So Idaho. Let's hit on that real quick. So, because I just read I think it was in the Wall Street Journal yesterday, or it was the New York Times, one of the two. Talking about Boise, and it does seem as though, you kind of mentioned it, that it's a supply and demand issue. The demand is crazy. So do you, right now, what do you attribute it to? Is that, how much weighting do you give to that imbalance when it's present?
Yeah, right. Well, yes. So in the framework that I share, like in price income deviation framework, Boise at the beginning of COVID was 33% overvalued.
Okay.
That was out of 800 cities in America that have more than 50,000 population. That was the most overvalued city. Mm-hmm. Where the second most overvalued was only at 18%.
Wow.
Las Vegas or something, I believe.
Yeah.
So Boise does appear in governmental data overvalued now, unless there could be some noise there or something, because it's a very small geography. But I don't think so. And now they appreciate it over the course of 2020. I think another 10% or something. Yeah. I don't know where incomes are. So as of the latest, like when I updated my data end of last year, let's say, it's just governmental data is like really slow for on the income side, for example. So it's a little bit lagging. So I don't exactly know where incomes are in Boise, but I sort of just prorated them forward from the prior levels. And assuming, let's say, those are normal growth, that's normal growth. Boise is even more overvalued right now at like 37. So that's that's what I see there. Idaho as a state is 25% overvalued. The only sharply overvalued state after Idaho is Nevada, 16. That's what I see as of year end to 2020. Nevada 16%, Arizona 14%, Colorado 14%, the District of Columbia 12%, and then Texas and Washington states at 10%. So that's it's very mild, very mild.
Yeah.
Everything else is fairly. I mean, a few other markets are fairly valued. The majority, a few other, let's say, states are fairly valued. The majority of U.S. states, like 30 of them, are undervalued. So that's what I see. But Boise and Idaho appear over the top.
Yeah, which would line up. I mean, and even in this article, I mean, the examples and the people they quote. I mean, it was ridiculous stuff where someone like literally bought the house and then let the seller, get free rent for 5 months, like just weird things like you've never heard of before. And there's some other example in the article. It's just like ridiculous, something I'd never heard of. But it's interesting because it struck me. And obviously I'm in Oregon, so we're close to Boise. We have clients in Boise. So it's interesting how the data does line up with what does seem to be, completely out of control enthusiasm for that area.
But let's say another, like one of the best performances, let's say Denver. We can say Denver, Colorado. So that has been, top performer as well. And the Denver, Colorado, I'm not sure where it stands right now, but I can look it up. But as of like last year, as of that's the beginning of COVID, then Denver, Colorado was actually fairly valued at 0%, and the market was, I think, about 80% above its previous peak in 2007. So it's like a humongous boom.
Yeah.
And yet it was completely justified by the economic fundamentals there.
Yeah.
So it's not. And then, like this kind of, sometimes you hear narratives, like I live in the Northeast and I hear narratives about some markets being overvalued in the Northeast, or a market's going to crash in the Northeast. Like, you serious? It's like, this is, it's a depressed, market, broadly speaking, the Northeast, with the exception of a few cities. Obviously, that's very different. So we've had New York City growth and et cetera, like a few cities. But I mean, that's overall a market with population decline, as many of multifamily syndicators know, et cetera. It's places like the states like New Jersey, they're undervalued. Now, some people, I invest in Hudson County, New Jersey, by New York City.
Yep.
Now, that can have some concern. That's a fairly valued market. It's got very nice price performance as well. And it's not overvalued, but it's kind of at zero or something. It's like that. And, a market that is just fairly valued can drop. But a lot of the other, regions in New Jersey or New York State that are 15% undervalued, I mean, they're not going to drop. Like, people can just chill and not worry about it, because it's not, it's not how it works. I think it's just, real estate is very fundamental. And then there was another, I had just as a funny story. I was in a room on Clubhouse. So I got invited to, and there was, I don't want to mention the name. Like, there was a guy, who wrote a book there is a guy who wrote like the more famous book on creative financing, let's say.
Sure.
And so he probably knows something about creative financing, but now he was writing, had written a book on basically how there's like some kind of systemic issue in U.S. Real estate, where age of housing is getting, housing is getting older and older.
Sure.
And that's going to be some kind of predictor of a crash. That was his thesis.
Yeah.
Now, okay, I don't even know, like, is he running regressions on this thing or not? Because if you try age of housing, like, there is governmental data, I can pull it myself and like look at it and like try to predict price downturns. It's probably not going to work.
Right.
I have even looked at like housing supply, etc. It's probably not going to work. And that's additionally would kind of point to like regions with old housing, like the Northeast, potentially dropping. And
sure.
And that's not a concern I have. I don't think that's happening, because those are the undervalued regions. And that's just like just want to point to kind of like to maybe calm people down about like some of the concerns they have, that, like, or people in, like I said, in markets like New Jersey, feeling that their market is oversaturated and prices are high. I mean, high relative to what the prices are not high in New Jersey. And I understand that now competition, now in Hudson County, there's very high competition. Now I've tried a few, a few projects, in Jersey City. It's very competitive to enter. It's like definitely the case. But it's just like, this is just a perspective, like kind of to give my thought process. And on deals, I think it's very useful to harness data. I think now we have lots of data that is public. So what I do personally, I basically try to get all the data that is public. So if it would be small multifamily around New York City, I would pull like 6,000 of them. And then I know people don't get very excited because they think that's on-market data, and it's true, and that's not so exciting, and you have to get only off-market. But it depends. Now, if you have so much data and you're doing this systematically on a weekly basis, at the tail of this distribution, you're going to find some deals. And, I would imagine even in bigger CRE, or let's say at least maybe sub $5 million deals, definitely there would be opportunities. And, I've seen a lot of like the syndicator deals that get posted on LinkedIn, and I often manage to find them on Craigslist or something else. It happens.
Yeah, most definitely. Yeah, and it's a bit of a, I agree.
Now, I'm not saying that that's I'm not being silly to say that that's like the predominant strategy in CRE. I understand it's not. I understand why off-market works and so forth. But, it's just still there is value to them.
Yeah.
In off-market, there's ways you can pull data, you can price. I wanted to post on Towards Data Science, like a model that kind of prices different apartment communities, for example, how they're, let's say, how much value add they have. So you can get data online for their rentals, etc. That is publicly available without even subscribing to CoStar or whatever.
Yep.
And you can get like quite good information. You can get like a list of, in this given market, all the big like 500 unit, etc. apartment communities, and kind of have them ranked and give them to your team to maybe focus additionally on some of them. I know, like, then people think you can just direct mail is cheap. It's true. It's like very few properties. So you just like send direct mail either way to all of them. But maybe if you know that those 5 are like real gems, kind of, you can really focus on them and they keep following up on them. And that's also like another, So I think data, I mean, I don't know. To me, like, investment is just kind of a little bit of a data science project.
I agree, and that's why I'm glad we had you on. And it's this is the stuff, right? Like, there's the point is that just using your gut to just like, oh, that's pretty pictures, or that's, or someone said whatever they're saying. Okay. You teach his own, man. You got to do what you think is right. But I think that it just proves that there is a method to the madness. There is data that's out there. There is a more analytical approach to sort of how you make decisions. And as humans, like we have a lot of flawed thought processes, right? Like we have thinking errors. And I think that it's impossible to sort of filter all of that out, because that's what makes us human. But at the same time, we have this brain that's also super powerful and can be trained with data, and you use these things. You can make better, more informed decisions. And I think that, just taking some anecdote that people throw out there, like you said, some guy's going to write a whole book about something that's complete rubbish. And he'll completely convince himself through the writing process that he's absolutely justified, in whatever his thesis is. Whatever. It's interesting. And that's why I like how you've got your own approach. You've done your homework, and you've got now the way that you look at the world, and you use it, and it's based on data.
Yeah. And you're right that, it's, you're right that one needs, there's intuition, there's feelings, there's like a lot of value to that. And that's, that's not to be discarded. But it's, it's just to kind of combine both and, use the best of both worlds, I guess. Yeah.
No, it's good stuff. Yeah. Well, I appreciate your time. So where can people, where can they connect with you? Like, you got a website or LinkedIn or?
Yes. So they can connect with me on LinkedIn. So Stefan Tsvetkov on LinkedIn. They can also go to my website, nvanalytics.com. So ENVVY with a double V. So that's my data OC. They can also get a report if they wanted to see, like, can get a pre-report on like overvalued states. Let's say, that they want to see, like, kind of some of the stuff we talked about today.
Cool.
Yeah. Mm-hmm.
Awesome. Well, I appreciate your time. All right, man. Take care. We'll be in touch.
Yeah. Thanks.